What is up, YouTube? This is the Working Investor. I have so many sandwiches. I feel like I work at Subway. When I mean sandwiches, I'm talking about a hedge. My goal is to receive 4% return per month in dividends, which sounds completely wild and insane when I say it out loud, because 4% per month is insane, because that's about close to 50% return per year in dividends, which is like phenomenal. The biggest problem with these high yield dividend paying companies that are based on options like synthetic cover call options, and I'm talking specifically through Yieldmax because, in my opinion, so far, I favor them the most based on my analysis of a layman investor, not a financial advisor, is that there's NAV. The biggest challenge is to preserve your NAV, your net asset value, because what good is it if you're getting $500 in dividends, but then you lost $500 in value of your underlying stock? So I'm trying to do hedges to preserve my NAV, my net asset value, and I'm actually running three different, we call it, the term here is sandwiches, but because you have two pieces of bread and you're trying to keep your sandwich whole. But really it's just hedges, and I call it synthetic, so I'm basically pairing a synthetic cover call with a synthetic put together. So Yieldmax offers TSLY, which is a synthetic cover call, and CRSH, which is a synthetic put. And now here's the play that I'm doing. So I'm changing up my ratios. I have so for TSLY and Crash, I have a 1-to-1 ratio. So I have $2,500, $2,500, $2,500 in there. Again, this is an experiment, and I definitely want to scale it up like crazy, but I want to see how this plays out, and then I could go ahead and go crazy. So it's total. I look at it as one entity of my Tesla dividend paying entity, and $1,250, $1,225, half is in the TSLY and half is in the Crash. And then in CONY and FIAT, so basically I'm playing with the cyclicality of the automotive industry, which tends to be very cyclical, even though Tesla has been catapulted up for a while. If you look back in the past few years, it's kind of like following like cyclical trends. But again, I'm not an expert of Tesla, but I just want to enjoy the dividends. And then as far as the Bitcoin craze, so basically, there's a lot of differences of opinions. Is Bitcoin real? Is it viable? Is it a currency? Is it an investment? Is it a speculation? All I could tell you is that Bitcoin is very, very cyclical. There's something they termed it the Bitcoin. When I say crypto, people synonymously exchange Bitcoin with crypto. The truth is that it seems like the crypto market kind of correlates with whatever Bitcoin does. That's like the oldest OG out there. So basically, CONY is a Coinbase company. It's Coinbase, which is a company that an exchange platform for trading cryptocurrencies, and they tend to be very correlated with the price of Bitcoin historically, what I've seen. And then fiat, it sounds like fiat currency, that's the synthetic put against CONY to kind of keep, kind of work against each other. So I do have 50-50 allocation, 2,700 in this experiment. And then I just opened up NVDY and DIPS. NVIDIA is basically on NVIDIA, and DIPS is the synthetic put on NVIDIA, and I have $5,000 total. But you'll notice here the ratio is actually a 4-to-1 ratio, because I'm more bullish. I have a bigger bullish thesis on NVIDIA with the AI and whatnot, and maybe it's a little overvalued because it's a craze, but overall I feel like it's a solid company in my personal opinion. But again, I'm not a financial advisor. But so I have 4,000 in NVIDIA, 1,000 in DIPS, so 4-to-1. It's 4-to-1. So basically it's just a little bit of a hedge when NVIDIA takes a little bit of a dip. I want to keep my net asset value somewhat preserved, but not a perfect hedge because it's not 50-50. But I feel like because NVIDIA is not as cyclical as, in my opinion, as Tesla or CONY, I feel like it's more to the right and up, like a positive drift, more so in general. I have more confidence to put, 4,000 in NVIDIA, 1,000 in DIPS. People talk about margin, and yes, when it comes to the DIPS and the fiat, according to Robinhood, I'm not sure how other brokers work, you do have to put up 100% margin, but these are relatively new. I'm talking like super new, like under a month, roughly about a month or less less than a month. Crash has been out there a little longer, and I've noticed that they don't require 100% margin when it comes to Crash. And I'm going to show you how my portfolio has played out with my net asset value. So you see here in Crash, if you scroll down, you'll see here, they no longer require 100% initial requirement for maintenance for margin and 100% maintenance. They require 50% and 35%. So it's a little bit favorable. Obviously, like dips just came out. It's fresh. It just opened up July 24th, I believe. It looks like. So hence, I would imagine that's why they require this initial and maintenance of 100. But down the road, I would imagine that as they've proven themselves, they've been around for more than a month, it would go down. So basically, if you look at the components together, I've actually made money on the hedge. Basically, on NVDY and dips, you'll see it's 4,041 and 1,006. So I put 5,000, just I say roughly close. Maybe round it up a little bit, a couple dollars, but close to 5,000 total, and I'm up like close to 48, $40 plus, increase with this. TSLY and Crash, like I said, I put I think 2,500. So you'll see that 1354, 1184. So 1354 plus 1184. So yeah, 2,500. I'm up a little bit. Even with the question is, should I rip off the top with that little bit? But it's not worth much to rip off the top. It's so little. I may just leave it. If it really has a massive discrepancy, I may rip it off. So like sell it to pumps. But as a whole of $2,500, it held up the position even with the ups and downs and upside downs and whatnot. And then finally, let's see how the now I just put this position on a few days ago. Again, time will tell. The CONY and FIAT, I said 2,700, so 1312, 1389. So 1312 plus 1389, so 2,700. It's holding the NAV. One goes up, one goes down. It poses the other, but the 2,700 is preserved for the most part. So I have become the Subway sandwich man of the. I'm joking, but yeah, I'm doing a lot of sandwiches trying to preserve NAV, because who cares? This way I sleep better at night. I don't have to worry about what the market does. If somebody burped in what they did in the prospectus, here, I know that I have a hedge against the other. I mean, I do care to an extent, but it kind of helps me keep my portfolio more even. AMZ, I do not have. They don't offer inverse, and I'm happy. I'm very bullish. I'm like a perma bull with AMZ right now. So AMZ, I put in 5,000 into the position. I actually ripped off $50, and now I have a $27 increase in NAV. Which I will just chill for a bit. It has to be a significant amount for me to rip off, but we'll take it from there. So anyways, I just wanted to show you guys what I'm doing and how I'm trying to hedge. Of course, in the prospectus of the hedges, like I mentioned, they don't give any guarantee. They don't say, they say that, obviously if the market tanks, if you look at the puts and the strikes, if the market really went to zero, I'm not sure if any of the hedges will actually, I'm not sure if you work out. You always have risk of losing everything. Take your own risks. This is the Working Investor over and out. Hope you guys enjoy.